Futures are pointing to a higher open, but they have pulled back from some of the best levels of the pre-market session. Let's talk about the markets, the upcoming earnings season. Jeff Saut, Chief Investment Strategist at Capital Wealth Planning, and Simeon, we know he's a human. We know that, but his name is actually Hyman.
That's what it says in prompter.
Yes. Simeon, see, you say Simeon, and we're wondering. You know what I mean? Whether you're human or primate or whatever. Anyway, thanks for that. Global investment strategist at ProShares. Global advisors, we're always ready for anything. Saut, I'm going to start with you because you bring up a couple of the biggest names ever in investing, Buffett and Ben Graham, with sort of different things. And I'm wondering which you are. You say the most important thing is follow a trend when it's evident, and that's higher. The other thing that when you mention Graham is if you take care of protecting the downside, the upside will take care of itself. I've never thought of you as a taking care of the downside risk type guy. Is that always in the back of your mind? Because you have stayed pretty long and pretty bullish. But are you always thinking about whether there's a risk to the downside?
Yeah, I think you have to manage the downside in portfolios because if you avoid the big losses, my father used to tell me, the upside takes care of itself. We've had a good start to the year. You had the Santa Claus rally. You had the first week of January up. That tends to bode well for the rest of the year. On average, when you have that sequence set up, you get an 11% gain in the year. That's pretty much what we've been looking for this year.
Simeon, you wrote a piece recently, impeachment, a coming election, and a near-record market rally. What's it mean for 2020? And we have never seen anything like this before. There's never been an impeachment of a first-termer. So you need to somehow navigate that we're in the middle of an impeachment with a guy who's, at this point, unpredicted as favored to win re-election. And we're in the middle of an impeachment. It's so bizarre. How can you possibly decide how to invest based on that? I've never seen this before.
I think predominantly the markets are going to ignore the impeachment and look at the economy. And I like the payroll setup because I think that's key to what's going on right now.
The consumers?
We're in a Goldilocks, and a Goldilocks created by weak manufacturing but a strong consumer and services sector. I mean, why we're not having any wage growth? Because if you're working at McDonald's, there isn't an assembly line job that you're going to get when manufacturing gets tight to triple your wages. That's as simple as anything else. And that's keeping us in that 2.5% GDP growth with low capacity utilization that can keep going for a bit longer and keep the Fed at bay. And that's good for stocks.
Well, does that make sense to you? Jeff, too, you like the consumer, right? As long as the consumer goes, you figure this recovery stays intact?
Yeah, a lot of my bullish tilt here is because of the strength of the consumer. And I think the consumers and, the balance sheets, if you look at household net worth, they're at all-time highs. Consumer, I think, continues to spend. And I think the economy is actually going to grow better than the 2.5% as we get into the back half of 2020.
I just wonder if that's built into the market, Joe, this idea that we're not going to be at 2, because you think about a 29,000 Dow and 2% GDP, they seem a little bit out of kilter to me.
Unless one is artificially low from a headwind from trade that now
goes away and you get back end better growth. That could be.
There's another little catalyst that I think people are forgetting about, and it is the sort of bouncing ball of the corporate tax cut. In 2018, net margins in the S&P 500 went from 9 to 10% temporarily from the tax cut. That was priced in, and half of it went back. Now we don't have to anniversary it anymore. There's a little bit of an extra tailwind to earnings because we've had the tax cut already priced into prices.
Jeff, you were on not too long ago. We got your target. Just remind me of the S&P. Where do you think the range is this year? Do we stay above 3,100 or?
I think that depending on what multiple you want to put on the $177 and bottom up operating earnings that I have for this year, anywhere between 3,400 and 3,600, and I think that's reasonable given the backdrop and the inventory overhang. I think goes away, and I think that allows GDP to grow closer to 3%.